Welcome to Bloomberg Technology. I'm Taylor Riggs in New York, in for Emily Chang. Stocks ending the day in the red, with tech leading those losses. This is all amid rising trade tensions between the U.S. and China, adding some concern about the pace of the recovery due to the pandemic. And the numbers on the pandemic showing that U.S. virus cases rose today 1.5%, in line with last week's average. And this all comes, of course, as more state and local governments prepare to open up in phases. I want to break down all of these headlines and what it means for markets with our markets correspondent, Abigail Doolittle. Abigail, tech continued to underperform today, and it's something that we've been seeing in recent weeks. Where is the leadership that tech typically provides?
Well, it certainly was not there on the day, and that largely has to do with one of those headlines that you were talking about, ratcheted up tensions between the U.S. and China. Now, those tensions have been there in recent weeks, but markets ignoring it to some degree. But last year, if you recall, on the trade tensions every other week, risk on, risk off, depending on those headlines. Well, right now, there are concerns, again, that those headlines, a war of words between the U.S. and China, taking down tech. And the reason tech is a little bit more sensitive, a lot of these companies receive quite a bit of revenue from China. For example, Apple, the tech heavyweight, receives about 20% from China. And the chip sector, that is really super sensitive to China, given the supply chain and the revenue dependence there. So we see the S&P 500 tech index down more than 1%, the stocks down even more. However, over the last 9 days, Taylor, we see there a real roller coaster ride for the chips, because last week was risk off. This week, right now, we actually have gains. How it will end is all going to come down to tomorrow. But today, a tad risk off, especially for technology.
And speaking of some of the technology stocks that we're following, Abigail, NVIDIA out with earnings. It was interesting. I'm curious if we see both the data center as well as the gaming chip demand that, frankly, we thought we would see from this company in the quarter.
Well, you know, the data center revenue was really pretty solid. They put up more than $1 billion in data center revenue for the first time ever, so that's a positive. Overall, they beat both revenue, I think, by about 3%, earnings by about 7%. The 2Q guide in line. Now, you see the stock off in after hours. That could have to do with the fact that investors wanted a little bit more. As expected, the auto segment was weak. On the year, though, this has been a huge winner. This stock up in a big way, up more than 40%, up close to 50%, in fact, at a time when the S&P 500 is down slightly, the NASDAQ up just a little bit. So that huge outperformance tells you these shares priced to perfection. So it was a good quarter, good outlook, but not quite enough to send the stock higher, at least in after hours, Taylor.
I was doing some research, Abigail, and it looked like the forward PE basis of the S&P minus the S&P and some of the big five, some of those FANG names that we talk about, has been widening out, sometimes going back to the widest now since July 2013. What is the FANG showing you, and particularly Apple within that? Is that providing any leadership as well?
You know, there's a real tension between that valuation gap that you were talking about, the tension that we've had this year, and that outperformance for the FANG stocks, because those FANG stocks have been on fire. Many of them stay at home, so they've been getting a huge bid up on good result. However, once you see this economy reopen, those stocks perhaps not going to do quite so well. So it'll be interesting to see whether or not that closes the valuation gap. And on the year, there's really just a huge divergence. Expedia was one tech internet name that reported recently, as expected, not a great quarter. So that stock this year being hit by the virus down in a huge way. Apple and the NASDAQ 100, one and the same, up about 5% on the year, as you know, that bellwether really carves the path. But those FANG stocks, Taylor, that valuation sky high on the stay-at-home gains, up more than 20% on the year. It's going to be very interesting to see if the economy does reopen, as so many market watchers and Americans, quite frankly, hope, if those FANG stocks, the stay-at-home stocks, the new defense will continue rising, or if we're going to see some of that sector leadership rotate along with some of those valuation gaps that you're mentioning, Taylor.
Well, my thank you, as always, to Bloomberg's Abigail Doolittle. I want to stick with Apple as well, because they're ramping up, and it's pushing now into some of the original podcasts by seeking an executive to lead this initiative and buying shows that would be exclusive to its services. This comes just one day after Spotify acquired the exclusive rights to Joe Rogan's podcast. For more, we're joined now by Bloomberg Technology's Mark Gurman, who covers Apple for us. Mark, we know podcasts are popular, so why now? Why this new sort of original push into the podcast arena by Apple?
Hi, thank you for having me. Apple is pushing stronger than ever into original podcasting, and the primary reason for doing this is sort of as a way to push Apple TV Plus. They are growing in their content for TV Plus, and putting podcasts as part of it will give more value to that $5 a month subscription price. It's also, like you mentioned, a very hot area for other tech players like Spotify right now. Apple really pioneered podcasting 15, 16 years ago, and clearly the market for podcasts is moving towards companies buying originals.
It seems like a very clear push to further integrate podcasts with Apple TV Plus. Is that the very clear strategy that you two see as well?
Yeah, that is absolutely the strategy here. A lot of the originals that they're working on and acquiring are TV Plus specific. So I'll break it down for you. There's two types specifically that they're looking at. One is a category of audio podcast shows that would be spin-offs of existing movies and TV shows on Apple TV Plus. The other would be wholly original new things that aren't based off of TV Plus, but that could eventually be adapted into TV Plus movies and shows. So at the end of the day, it all comes back to TV Plus.
We also mentioned Spotify acquiring the rights for Joe Rogan's podcast. Spotify, clearly a formidable competitor here. How does Apple try to differentiate itself and really keep up with what has become a relatively competitive space?
You know, Apple's big competitive advantage is the fact that the podcast app from Apple, the Apple Music app, the Apple TV Plus apps, they're all built into the iPhone, right? They've sold well over 1 billion iPhones at this point. So that's a gigantic user base, plus, 500, 600 million other iPads, Apple Watches, AirPods, Apple TV combined, right? Spotify is a software. It's a platform player, so they don't have that built-in hardware advantage. Apple, of course, also has that huge marketing arm, right? You can't drive down the street here in LA without seeing a big billboard for Apple TV Plus, and they obviously have the money and the resources to push original podcasts as well as part of the TV Plus program.
What is the monetization strategy?
So monetization here would definitely be, or very likely be, part of that paid subscription as part of Apple TV Plus or Apple Music, right? At this point, it seems like these types of shows, Apple originals, would be paid for by Apple in lieu of the podcast producers not slapping advertisements on top of the programs. What you see Spotify doing is a mix of both, so they're paying for shows, but there's also advertisements here. More likely is for Apple to skip advertising. Advertising is a very small segment of Apple's overall services revenues. It's basically tied to App Store search ads and the search results. Developers can place ads, but also in some other applications like Apple News. But we're not seeing that as very likely for this podcasting effort.
And Mark, like you know better than anyone, anything to sort of boost some of that services revenue that the company more and more wants us to become hooked onto. One final question here. When you talk about an original podcast program, it has to have a clear leader. Who could be the front runner here to lead this effort?
That's a good question. So they are looking for someone to sort of lead the original podcasting efforts. This is probably going to be a bigger name podcast producer or someone from a podcast company, and this person would be reporting to Apple's head of global podcasts. And you'll likely see these people take a bigger face as part of this initiative, like you've seen the Apple TV Plus executives have a bigger face and frame on these efforts for the TV side of things.
Well, our thank you as always to Bloomberg's Mark Gurman. And coming up, we will look at social commerce with Michael Levine of Pivotal Research, what he has to say about Facebook's latest move. That is next. This is Bloomberg. Continued growth in e-commerce and social commerce during the current pandemic, and while Facebook wants a piece of it. Mark Zuckerberg announced Tuesday that the company will recommit to online shopping and commerce, and that he personally will be involved to do so. Joining us, we're joined by Michael Levine of Pivotal Research, who has taken a break from cold water surfing to join us today. Michael, always great to have you here on the program. Give me some of your initial thoughts about Facebook's shops and really some of the opportunities that it could unlock for the company.
I mean, thanks for the lead-in, Taylor. Look, I think it's pretty fascinating. I mean, one of our messages to clients, just even looking as earnings season's gone by, is it's been pretty apparent that if you basically have a store, if you've underinvested in your presence online, like, you need to get there and you need to get it figured out in a hurry. And I allowed Facebook for doing something I think a little bit different than what they've done before in their prior attempts, because stores is not necessarily a new thing to them. Marketplace is not a new thing. I don't really think it's seen a ton of traction. I think investors have been sort of waiting on this for about a year and change, and I think they realize the same thing. Like, this is the time to get behind it, and I think they've also done a very good job trying to help support the small, medium business community. So what to me is very different is the much more open ecosystem that they're embracing. So working with companies like Shopify and BigCommerce that are very frequently used solutions for small businesses. So they're just making it a lot easier to basically take the on-ramps.
Well, and you kind of alluded to the next question there, where they're making it easier, where I think earlier efforts had been maybe disjointed, for lack of a better word. You know, you had Instagram checkout, you had some branded content on other platforms. Do you like the way the Zuckerberg with Shops is making this a cohesive plan that should be seamless across its, quote, family of networks?
I do. And look, the thing I would say is I'm not completely convinced that they're going to have massive success in terms of becoming a destination. And it's one of the things, if you look at the evolution of the big internet properties, I think when people have an association of this is why I go to Facebook, this is why I go to Snapchat, as compares to this is why I go to Amazon or eBay or Netflix, where you're like, I'm going to shop, or I'm going to basically watch streaming video, and if I don't have an account, or if I haven't purchased an item, I'm going to purchase it. So I think they've got such a large amount of traffic, they should be able to have a lot of success there. But if they just actually change advertiser behavior, and it follows on this pretty big announcement from Google Shopping a couple weeks back as well about free PLAs, to just say, let me think about cataloging my products in a way that I can upload them to be it Google, be it Facebook. It's just going to be a much better advertiser experience. So you can have something that's contextual to what somebody might be looking at on Instagram, an ability to basically shop right there. And it's to me, it's gravy if they can go ahead and actually become more of a destination site in e-commerce. I'm not completely convinced there yet, but I don't think it needs to be be a home run. Is
there any regulatory pushback?
I don't think so. It's good that you're bringing up regulatory, because the whole regulatory subject feels like it's gone a little bit flat. Was definitely not hearing about it as much from investors as we're sort of mid-COVID, and I think at least it's interesting that there was certainly chatter that the FTC was going to seek an injunction around Facebook integrating some of the properties on the back end, which will probably make it a little bit harder to pull apart. So I don't know if they're necessarily completely out of the woods. As we got this reminder, obviously, about Google in last week. So, but this in itself, I don't look at as being a regulatory issue. They definitely don't have particularly dominant share whatsoever on the commerce side. So.
Yep. No, I totally hear you on that. And I want to broaden out and sort of talk about the advertising market in general. It's pretty interesting. We came into this year thinking Facebook, Google were going to be some of the best performers. And then, of course, the pandemic hit. And you had talked a lot about some of the weak advertising market that was facing these companies. And yet then the first quarter results came out and things were looking a little bit better, at least for Facebook, than we thought. How are some of these companies positioned now that you're looking at a reopening when it comes to the advertising market, and if that demand on the part of the advertisers is really there coming back in full force?
I still am hearing about a decent amount of hesitation on the brand side. Direct response has really been the big surprise. And out of first quarter, like to me, the biggest takeaways were, one, these companies were doing terrific in advance of COVID hitting. I mean, we had Snap pacing up 58% for the first 2 months of the quarter. YouTube had likely accelerated to mid-40s. They didn't exactly say that was the number, but off of a 31% number for Q4. The thing that's been surprising has been how well direct response has hung in. So the feedback we've heard from a lot of native DTC companies is that you've seen Facebook pricing come down 35 to 40%, and like on top of the benefit they're getting from lower price media, you're seeing higher conversions because you've just got a captive audience who basically can't go shopping in offline, and so to me it's been an interesting phenomenon. There'll probably be some give back in terms of what's been described as Christmas early to me by more than one of these advertising cohorts. I think that brand is still going to struggle a little bit, and so my guess is the recovery at somewhere like Twitter, at the non-connected TV components of a company like Trade Desk, maybe a little bit more slow in the recovery. But a lot of the other guys have got a good enough footprint on the on the direct response side. And I mean, look, if anything, Google is probably among the weakest of the large caps. But when you think about the amount of SMB exposure and travel exposure they've got, I mean, I thought they were actually pretty darn good results.
And then when we all start to open up, and assuming a lot of us go back to the stores, how does Facebook and companies like Google still capture that audience? Do you see this as a structural change, or are they launching this and the timing's good because we're in a pandemic, but then what happens when things potentially start to go back to normal?
I mean, my view is there probably is some degree of pull forward that's happened with regards to e-commerce, but I think the genie's just out of the bottle at this point. I mean, we're still relatively underpenetrated by way of comparison in terms of if I look at something like China as a comp, and I mean, I don't know about you, like I'm not in any rush to go back to CVS to buy stuff. During the pandemic, I've basically realized I can get a time efficiency and cost efficiency. So I think as I listen to all these companies during earnings season, I think it's just been this exogenous pull forward that's accelerated. I think Microsoft summed it up pretty nicely. Where they talked about on their earnings that they've had a couple years of digital transformation accelerated in the course of a couple months. So, maybe we'll slow a bit on the penetration side, but it'll be basically off of a much higher plateau.
Well, covering a slew of topics for us there: Facebook, Amazon, Google. Our thank you as always to Michael Levine of Pivotal Research. And coming up, Ready Player Amazon, the e-commerce giant, is entering the video game arena, but can it lure players away from hits like Fortnite? We'll discuss next. This is Bloomberg. Amazon's first major video game launched yesterday. Crucible is a free-to-play PC game that the e-commerce giant hopes will help it become a force in the $159 billion global industry. To tell us more is Bloomberg's Priya Anand. Priya, there was a lot of optimism and expectations around this game. So I first have to ask, how was reception?
Well, it's unclear as of now, right, how much of a success the game is going to be. By one measure, which is looking at Twitch, which is owned by Amazon, their own live streaming platform, where you can see, what games are popular that people are live streaming. Crucible has not broken into the top even 20 games on Twitch right now, or 20 categories that they have for live streaming. So that's one measure where you can see how it's doing, and even presuming that maybe Twitch was helpful in some ways in promoting the game, it seems like it still hasn't really cracked into that top echelon.
So let's take a step back and tell us why Amazon is interested in this space to begin with.
Amazon has long been interested in adding different kinds of entertainment to the Prime subscription. And, especially in this world now where fast shipping is becoming more and more common among other retailers, having more and more packed into that Prime subscription is important for them as a way to draw people in and get them to keep spending. And having entertainment in all different forms is clearly been important to them, having Prime Video, and video gaming they view as part of that, from what I've learned from some sources. They see it as a huge space, an industry with tons of cash, tons of people enjoy video gaming, right? So it's like their investments in video in a way.
And it's interesting. This is sort of the time when Amazon is actually not the big player in this space. It's going up against Electronic Arts, Activision Blizzard, Microsoft, really big players in this space. What is Amazon's strategy to stand out, to differentiate, and really to compete with some bigger players in this space?
Well, what's not clear is how they're going to do in terms of actually developing their own video games, right? Like, they've got this game out. They have another one coming out later this summer. People being stuck at home in certain places or not going out as much might help them. They have a couple of different pieces to their video game strategy, though, right? They're reportedly working on a cloud game streaming service. And that would, reduce the need for expensive hardware like consoles. They also bought Twitch back in 2014, and they quickly, within a couple of years, rolled that into the Prime subscription. So if you are a gamer and you're on the fence about whether or not you want to get Amazon Prime, there's a version of it where you can get all these added benefits like free games, et cetera, through Twitch. It's essentially just an Amazon Prime subscription, just with Twitch benefits and gaming-related benefits looped in to try to attract a different kind of demographic into the subscription program and lock those people in.
Well, and you've mentioned Twitch a few times. How much of a benefit can that be to the company?
It's unclear how much of a benefit it can be in terms of pushing forward their own in-house developed video games, right? This is Amazon's first game that just came out this week, first big budget game. And it's unclear how much Twitch can help actually push that forward if it's a game, if it's not a game that people are interested in playing. And I think we need a little bit more time to watch that play out and see just how much people like this game and if they do or not. And I think that'll probably have some bearing on Amazon's ability to attract talent to develop more video games for it.
Wonderful. Priya Anand from Bloomberg, thank you as always for joining. And coming up, our conversation with Bracken Darrell, CEO of Logitech. We'll hear how the pandemic-fueled work-from-home boom has the company on what one analyst calls an impressive run. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in New York. Facebook is announcing more plans to transform its workforce in light of the pandemic. In an interview with Bloomberg News, CEO Mark Zuckerberg said the company will hire more remote workers, even work from home permanently if they'd like to. He believes that remote workers could make up 50% of Facebook's workforce in the next 5 to 10 years. One company benefiting from the work from home boom is Logitech, and CEO Bracken Darrell joins us now. What I love having about getting you on this program is you really have a lot of insight into consumer behavior. What are the trends that you're seeing from computers to keyboards to game consoles? What sort of permanent and structural shifts have you really noticed in the last few months?
Well, our whole business, as you suggest, our business is really structured around these secular trends that are going through. The rise of video, people using video everywhere in the office and at home. PC gaming, so gaming at home, and then remote work, working from anywhere, and then the democratization of creating your own content through Instagram or Twitch or YouTube. And so those long-term trends have been continuing, and our business has grown really well over the last 4 or 5 years against them. What we're seeing now is all of them are accelerating, as you might expect.
Are you seeing these as permanent shifts? Are you preparing your business for that?
Yeah, I think these trends are permanent. I don't know if you can expect the kind of growth rates we saw in our last quarter, which were really strong, especially the last month, permanently. But I think you can expect that these are permanent moves. More and more people are going to work from home. As you just said, Mark Zuckerberg announced that Facebook's going to be at 50-50 probably within the next few years. I imagine it'll be faster and even more. More and more companies do. Dell announced something. Google announced they're going to keep everybody at home until the end of the year, just about. So it's just a wave that's coming through, and I think it's going to be really hard to suck that wave back. One of the things we're seeing, Taylor, is that people really like working from home. There are downsides, but boy, overall, it's a great experience.
Yeah, I mean, you are right. More and more, I think of people around us are trying to find the positives in that work from home environment. It's interesting that you brought up earnings, and on that earnings call, you talked a little bit about inventory. Curious, given that you're in the hardware space, what trends are you noticing within inventory, within supply chains, sort of the disruptions that we saw there? Have those resolved themselves?
Well, as back in the middle of our fourth quarter, so our Jan to March quarter, we had a disruption in our supply chain because China completely shut down. So every factory, everything, we couldn't make it stick, couldn't make a single product for 3 weeks. So that put us on our heels, and we had a lot of catching up to do. So we started to ramp up, and by the time we got to the end of March, we were almost at full capacity, and now we are at full capacity. In the meantime, this other thing happened called, shelter in place. And that drove a run on some of our products, including webcams. So we immediately sold out of webcams, and we're on our way back in those. So I'd say we've had 2 waves of supply chain disruption, one a bad one, and the other one kind of a favorable one.
And you're finding that you're being able to replace a lot of that inventory that is so desperately needed right now on time or as soon as you can?
Yeah, absolutely. We're really good at ramping up and ramping down. So we're ramping up quickly, and we should be in better shape by the end of the quarter. We'll be in good shape.
Do you have any supply chain exposure in China? I know, for example, today we've been increasingly talking about ramped up trade tensions between the U.S. and China and some more tariffs and retaliation. Are you concerned at all about moving a potential supply chain, if you have it there in China, to somewhere else?
Well, we lived this last year, right? So we had tariffs across many of our products, and we're pretty good at doing 2 things. One is we tend to be the leader in our category, so where we needed to, we could raise price and reflect the tariff cost in the pricing. And then in other cases, we could move manufacturing. We move manufacturing very regularly. We have our own factory, but we also make about half what we sell in other people's factories. So we're used to moving things in and out. So we moved things out where it made sense. We left things in where it didn't, and we'll do that again if we have to.
What has the recovery in China looked like, and what sort of insight can that glean to a recovery that we're now starting to look at in the U.S. as we start to talk about phases of a reopening? Is there any insight that you're noticing in some of the Asian countries that you can sort of circle back and glean to the U.S.?
Yeah, I think the right country to focus on is China. I would say it's probably not the Asian countries, because a lot of them are, especially the developing countries, are still sort of in shelter-in-place mode like we are. Yeah, I think, you're seeing in China, at least, we're seeing things are coming back to a more normalized level. And while the growth is not enormous, it's good, solid growth. And this is just 2 or 3 months after the shelter-in-place programs went through there. Now, they were already way ahead of us in being online. So they were, in our business, for example, we had 70% of our business was already online compared to about 35% before the pandemic here. So maybe they had a little bit of a lead in bouncing back, but overall, it looks pretty good over there.
You also have to anticipate some changes in consumer habits to be prepared for a spike in inventory and a spike in demand. What sort of consumer habits are you anticipating, whether it be video cameras or some new devices that you then expect the consumer to adopt in the next 6 to 12 months?
Well, we keep a lot of our new products a secret, Taylor, so I couldn't disclose it here, or they'd have to.
We're here to make news. Come on.
Well, I happen to be holding a new product. It'll be very exciting, but I can't show it to you on camera. No, I think the reality is you're going to see. I think we'll continue to see good, strong demand in gaming. Gaming is a fascinating space. The World Health Organization actually encouraged people, partnered with some of those companies you mentioned earlier in the broadcast, to encourage people to play a part together. To play safely, be able to stay socially connected, playing video games. And I think, even if they hadn't done that, and that has no effect, the rise of PC gaming and virtual gaming is not going to let up. So I think you can expect more there. I think you can expect more video everywhere. We're on video, out of my house. I've got 3 setups in my house. I encourage everybody to have at least 3. Of course, that's very self-serving. But I think there will be more and more people doing video out of their homes and trying to look better on videos. They're going to upgrade their cameras. And then finally, the most exciting thing to me in a way is the creativity, the explosion of creativity that's come out of this period. The dark side, of course, is the unemployment, the illness, the effect on families. The bright side is the constraints we put on everybody has created this explosion of creativity, and whether it's musicians or bloggers, and I can't tell you how many people I've seen creating their own video blog now. It's super exciting, and we're in the middle of that business because we make the equipment and the tools and a thing called Streamlabs, which is a service that you can use to become a streamer.
Well, Bracken Darrell there, CEO of Logitech, on all of that consumer device insight. Really appreciate it.
Thank you so much, Taylor. It's great to be here.
Now, the U.S. has pledged as much as $1.2 billion to AstraZeneca to help make the University of Oxford's COVID vaccine. Bloomberg's Jonathan Farrow spoke with AstraZeneca CEO about the price of the vaccine and distribution.
We have to show the vaccine works, of course. Second, as it relates to the share price, I'd like to remind everybody we are doing this at no profit during the pandemic. So it's important to keep this in mind. In terms of the timelines, we have an ambitious goal for our clinical trial, but you have to remember we're talking about vaccination for respiratory infection. So you can vaccinate people very quickly if you pre-select patients. And then, of course, if you have a lot of infections, if the disease is still very intense, you can get the results very quickly. As far as manufacturing, we have identified supply chains that are independent, one for the U.S., one for Europe. We're looking at India, and we're also looking at China separately. So there will be no competition between geographies, and we believe we can actually get this done quickly. The manufacturing process is a biofermentation, something we know very well because we do monoclonal antibodies, a similar approach. So we are confident that we can make it happen. But of course, it is certainly a challenge. We have to recognize it.
Well, it's a massive challenge, and quite clearly global pharma is really coming together. And Pascal, I don't want to be naive about this. You're a listed company. You are a private company, a company that's public, of course, but in terms of making profits, you are not run by the government, and you're not a charity. So when I'm thinking about the backing that you're getting from the US government at this point, I'm wondering how you can assure us that this vaccine will be disseminated in a fair way without a preference towards the countries with the deepest pockets. How can you make that assurance this morning?
Yes, well, first of all, I would say we are commercializing it, or distributing it, I should say, at no profit, and the cost will be very low, just a few dollars. So it is easily affordable by mid to high income countries, so there's no issue there. For the low income countries, we're working with global organizations like CEPI, Gavi, that are supported by the Gates Foundation in many countries. And we will find ways to bring this vaccine to the people around the world, even those countries that have very low income. But the value of it is that the cost is going to be very low. And therefore, cost is absolutely not an issue for mid to high income countries. The issue is a manufacturing capacity. And that's what our team is working on 24/7. They've done a beautiful job over the last 10 days, and they'll continue working very hard on that. We have secured $1
Pascal,
billion
you said it yourself.
capacity, by the way.
This won't be about cost. This will be about production capacity. And my question to you is a pretty simple one. If you've been backed quite heavily by a couple of developed countries, are you assuring to us that they won't be getting the vaccine over everybody else? My question to you is basically not how much will this cost, how do you fairly disseminate the volume of the vaccine to distribute it evenly globally without a preference on a single country over others?
Well, Jonathan, there is no preference for any country. And as I said, we have geographic-based supply chain, so we can serve everybody. The only issue is we cannot make a vaccine if people don't want it. So essentially, we're in discussions today with countries, governments, and global organizations. So they look at our vaccine, they make a choice, and they tell us whether they want it or not. There are alternative technologies, as you know. There's modified RNA-based vaccine. There's a couple of those, 2 or 3. And there are other technologies as well. So essentially, it's not for us to limit the distribution. It's basically for governments and global institutions to tell us whether they want it or not. And if they want it, we will supply it. The cost is very low, so it's not going to be a limitation at all.
That was AstraZeneca CEO speaking to Bloomberg earlier. And coming up, despite seeing huge demand recently, a public provider of remote work connectivity now plans to go private. We will hear from Bill Wagner, CEO of LogMeIn, all next. This is Bloomberg. As millions of people around the world continue to work from home, LogMeIn, a Boston-based provider of cloud-based connectivity, has seen a big surge in demand. But what will remain out of this now that some regions are slowly starting to reopen? Joining us now to discuss is LogMeIn CEO Bill Wagner. Bill, great to have you. I first want to ask, a lot of this caught people off guard. How did you prepare? Were you prepared for the big surge in demand that we saw as all these shelter-in-place orders really started to take effect?
Yeah, I think like a lot of people, we started to really think about this in the early February timeframe and start to build up capacity for what we thought might and could happen. And in fact, I don't think anyone could have seen the extent to which and how rapidly people had to shift to working from home. So I think the speed of which people changed was pretty surprising, but we did a lot to prepare, and I think since that time have invested a lot to make sure that we were ready. And I think like a lot of CEOs and a lot of companies, I think that first month, those first few weeks, you're really just focused on employee welfare and business continuity. So I think a lot of companies were scrambling, and certainly, we were moving as fast as we could during that time period, like a lot of others.
How are you now shifting now that we're starting to talk about reopening and having at least some employees maybe start to go back to work?
Well, again, I think I look at it from two different perspectives. One is as a CEO of a company who really lives and breathes remote work, and it's in our DNA. And so that's making us use this opportunity as a way to think about maybe we can operate differently as a company. Maybe this is a time for us to shift and embrace it holistically, as many other companies are talking about doing. And then, of course, secondly, our products, I would say the usage continues to be really high across a lot of our products. So while people are thinking about shifting back to work, I don't think that anyone will allow themselves to be caught flat-footed again like they perhaps were in the March and April timeframe.
Another issue that certainly caught my attention was you're a public company planning now to go back to being a private company led by Francisco Partners and a PE arm of Elliott Management. The board back in March has approved this. Is that plan to go private still on track?
Yes, it is. I mean, it's the shareholder vote was approved back in March, and it's a $4.3 billion all-cash deal. Transaction's a great outcome for shareholders, and that deal is on track. We'd always said at mid-year, just so we can clear all the regulatory approvals that are necessary, and we're looking forward to that transaction closing.
And why go private, especially when all the, quote, virus stocks that would really benefit from this new work-from-home environment have really been the leaders in the equity market and really had a lot of investor interest? Why now make the decision to go private?
I think for us, we have a pretty broad portfolio, and we were really focused over the last couple of years to invest for additional growth. And really, at some point, we felt we were a bit hemmed in by the public markets in terms of our ability to shift and make the kind of investments that we wanted to. And I think that this opportunity is going to allow us to make more investments, to move more rapidly. And I think this period is actually going to unlock a lot of innovation, not just from us, but from a lot of companies, larger and startups, because I think a lot more people are living through the real days of living and working from home and working differently. And it's exciting to think about how we might be working in the near future.
And just curious, given your decades of experience, especially within the tech sector, the dream, right, is to go public and to cash in. And yet, from your experience, maybe going private, if that's a better way to innovate and stay nimble, what would you tell companies, particularly in the tech sector, that are really debating the public versus private debate about maybe the right path to go?
Yeah, that's an interesting question. I think that a lot of entrepreneurs think about it. And yes, the concept of going public and IPO seems to be like the holy grail for a lot of young companies in startup mode. But there's so many different ways to have good outcomes for both management and investors. And for us and for a company of our size, companies go through a life cycle, and at different times in the life cycle, you need to operate the business differently. And at a scale like us, at 1.3 billion plus in revenue, we operate all around the world. We have 4,000 employees, and it's a complex business, and it requires a lot of attention for investors to understand the story. So in situations like that, where it's not as easily accessible, perhaps, it's a great opportunity for private investors to work with a company, work with management, and really make the investment, especially when they believe in the future as much as we do.
Well, joining us from Boston, and hope you are staying safe, that is the LogMeIn CEO, Bill Wagner. Thanks for joining us. And is still ahead, no more foreign brands. China's $1 trillion plan to boost national champions and overtake U.S. leadership in tech. We'll bring you the story next. This is Bloomberg. Amid China's worst economic performance in over 40 years, Beijing is accelerating its plan to overtake U.S. leadership in technology with a $1.4 trillion investment in store. President Xi Jinping backs the plan, which is waiting to be signed off by the China's legislature this week. For more, I want to bring in Bloomberg Technology's Shelley Banjo, who covers both the U.S. and the China tech scene for us. Shelley, what is this sort of post-virus stimulus tech plan that's underway? What does it mean now for Chinese tech companies?
Sure. So Beijing wants to pump about $1.4 trillion into the economy, and that's through things like rolling out 5G wireless networks to artificial intelligence, EV charging stations, just basically focusing a lot of money into the technology sector in China.
You know, you talked a lot about 5G. We've heard a lot about Huawei making plans in there. Is this a 5G play? Is there something else going on? What do you really see as sort of the devil in the details play here?
Yeah, I think there's a couple of things. I mean, the new infrastructure is definitely part of this big fiscal package that, you know, lots of countries are doing to kind of boost the economy post-coronavirus pandemic. But there's a whole bunch of other stuff under the surface around tech nationalism, reducing the dependence on foreign technology, countering and kind of sending a message to the U.S., which has been targeting Huawei and other Chinese tech companies. And so, you know, China is obviously using this as a way to boost its own economy, which, as you mentioned, has seen better days, but also to send a message to the rest of the world, which is, you know, we are going forward. You know, we're not letting this pandemic slow us down. We are going to use all this money and invest it into areas that we want to be a leader, and also really reduce our dependence on foreign companies, particularly those from the U.S.
How does the U.S. then respond?
And there's a whole lot of rising animosity toward China right now in all sorts of avenues. So you're seeing it from the president. You're seeing it from the president in the form of new sanctions against Huawei and from the administration there. You're seeing it from Congress in recent moves to delist Chinese companies in the U.S. or to kind of increase the scrutiny of them. And you're seeing it in the public in terms of polling numbers and kind of anger and kind of animosity toward China. And so it kind of goes across, kind of cuts across a lot of different areas.
Does this further put pressure then on the U.S. to have their own nationalism ideology surrounding U.S. tech, and then to push back on China and saying, hey, you know what, if you're going to support Huawei, we're going to do more to invest in U.S. tech as well? Would you see a scenario like that where the U.S. were to then put forth a plan to help our own tech companies?
Yeah, I think even before this, the pandemic had really shown people what kind of dependence the U.S. had on China for things as small as face masks to pharmaceutical drugs, to pharmaceutical drugs and other kinds of technology. And so you could kind of see a big move from Congress to say, let's take a step back and really look at that dependence and see what we can do with it. So far, all we've seen, though, is what you mentioned, the former, which is kind of this animosity toward China and these anti-China measures. We haven't seen as much of the counterbalance, which is, China's going to put $1 trillion into boosting their tech. Well, the U.S. should plan, X billion dollars to put into their tech efforts. So you really haven't seen that happen yet.
Well, we will keep our eyes peeled. I'm curious if that does ever get to the point where that happens. Our thank you to Bloomberg's Shelley Banjo. And that does it for this edition of Bloomberg Technology. Bloomberg Daybreak Australia is up next. This is Bloomberg.